You know what nobody's talking about right now? The fact that silver just did something it hasn't done in 43 years. And I'm not being dramatic when I say this. If you're sitting on the sidelines waiting for a better entry point, you might have already missed it. Let me paint you a picture of what's happening right now in the silver market, because this isn't just another silver's going to the moon story. This is different. This is structural. And the window I'm talking about, it's not measured in months or weeks. We're talking days, maybe hours before this opportunity fundamentally changes. 3 days ago, something extraordinary happened at the Comex. The registered silver inventory, that's the physical metal actually available for delivery, dropped below 41 million ounces. Now, if you're not familiar with these numbers, let me give you context. In 2020, we had over 150 million ounces sitting in Comex registered vaults. Today, we're at levels we haven't seen since the early 1980s, right before silver hit $50 an ounce. But here's where it gets interesting. The open interest, the number of contracts betting on silver's price, is sitting at 175,000 contracts. Each contract represents 5,000 ounces. Do the math with me. That's 875 million ounces of paper silver claims against 41 million ounces of actual metal. That's a ratio of 21 to 1. 21 people holding tickets for every actual seat in the theater. Now, I've been watching precious metals markets for 2 decades, and I've never seen a setup quite like this. Because it's not just the Comex numbers. It's what's happening simultaneously across every major market in the world. The Shanghai Gold Exchange just reported their lowest silver inventory in their entire history. We're talking about China, the world's largest silver consumer, essentially running on fumes. Their industrial demand hasn't decreased. If anything, it's accelerating with their solar panel production hitting record levels. But the metal? It's just not there. Let me tell you about a conversation I had last week with a dealer in Singapore. This guy moves serious volume. We're talking container loads, not retail coins. He told me something that should terrify anyone not already positioned in silver. He said, "The premiums don't even matter anymore. I have buyers willing to pay whatever it takes, and I can't source the metal." Think about that. In a market that's supposedly oversupplied, dealers can't find physical silver at any price. And this isn't isolated. I'm hearing the same story from London, from Zurich, from Dubai. The physical market has completely disconnected from the paper price. You're seeing silver trade at $29 on the Comex, while physical bars in Asia are changing hands at $34, $35. That $5 to $6 premium, that's not normal market friction. That's a market breaking. But let's talk about why this is happening now, because the timing isn't coincidental. There are 3 massive forces converging on silver simultaneously, and each one alone would be enough to drive prices significantly higher. Together? We're looking at a potential supply crisis that could make the nickel squeeze of 2022 look like a minor inconvenience. First, industrial demand is absolutely exploding. And I'm not talking about gradual growth. I'm talking about exponential acceleration. Solar panel production is projected to consume 185 million ounces of silver this year alone. That's up from 110 million ounces just 3 years ago. Electric vehicles? Each EV uses roughly twice the silver of a traditional car, and we're adding millions of EVs to global production every year. 5G infrastructure, AI data centers, military applications. Every major technological trend of the next decade is silver intensive. Here's a number that should wake you up. Total annual silver mine production is around 830 million ounces. Industrial demand alone is now consuming over 600 million ounces. That leaves 230 million ounces for investment, jewelry, and everything else. But wait, investment demand last year was 285 million ounces. See the problem? The math doesn't work. We're already in a deficit, and it's growing. Second, mine production is actually declining. I know that sounds counterintuitive with silver prices where they are, but here's the reality. Most silver isn't mined as a primary product. About 70% of silver comes as a byproduct of copper, lead, and zinc mining. When those base metal mines slow down or close, silver production drops regardless of silver's price. And right now, we're seeing major copper and zinc mines reaching end of life, with replacement projects years away from production. There's a mine in Peru, I won't name it, but it's one of the world's largest silver producers that's facing closure within 18 months due to ore-grade depletion. That's 20 million ounces annually coming off the market. Where's that supply getting replaced? It's not. There isn't a pipeline of new silver projects ready to fill that gap. Third, and this is the one that keeps me up at night, central banks are quietly accumulating silver for the first time in generations. Now, they're not announcing this. You won't see press releases. But if you track import data, If you follow the movement of metal through London and Zurich, you can see it happening. Why would central banks suddenly be interested in silver? Because they understand what's coming. Let me take you back to 1979 for a moment, because there are eerie parallels to today. Back then, inflation was raging, the dollar was losing credibility, and the Hunt brothers were accumulating silver. The price went from $6 to $50 in less than a year. But here's what most people forget. The Hunt brothers only controlled about 100 million ounces at the peak. Today, we have multiple sovereign wealth funds, family offices, and institutional players each controlling positions larger than that. And they're not leveraged speculators. They're long-term holders buying physical metal. The difference between 1980 and today? In 1980, the Fed could raise rates to 20% and break the back of inflation. Paul Volcker could do that because U.S. debt was manageable. Today, we're sitting on $35 trillion in federal debt. Every 1% increase in interest rates adds $350 billion to annual debt service. The Fed can't pull a Volcker even if they wanted to. They're trapped, and smart money knows it. So what does this mean for silver? It means we're heading into a scenario where industrial users are competing with investors and institutions for a shrinking pool of available metal. And in that scenario, price is the only mechanism that can balance supply and demand. Now, I want to pause here for a second, because if you're someone sitting on significant retirement savings, let's say $100,000 or more in traditional accounts, you need to understand how precious metals can fit into that picture. I put together a comprehensive guide on gold IRAs that covers exactly how you can get physical gold into your retirement account without triggering tax penalties. It's completely free. Links in the description. Worth checking out if you're thinking about diversifying your retirement holdings beyond paper assets. All right, back to where silver's headed next, because here's where the closing window comes in. Right now, you can still buy physical silver at relatively modest premiums. Yes, you're paying $3 to $4 over spot for coins, maybe $2 for bars, but that premium is about to explode. How do I know? Because it's already happening in the wholesale market. Large bar premiums in London have gone from 50 cents over spot to $2 over spot in the last 60 days. That's a 300% increase in wholesale premiums. When wholesale premiums are spiking, retail premiums follow within weeks. We're already seeing it. Some dealers are quoting $5 to $6 premiums on American Silver Eagles, and that's if they have inventory at all. But the premium expansion is just the beginning. What happens when industrial users start panicking? Right now, most manufacturers maintain just-in-time inventory. They're not stockpiling silver because carrying costs eat into margins. But what happens when they can't source metal for production? They start bidding against each other, and price becomes irrelevant compared to securing supply. I'll give you a real example. In 2021, there was a brief shortage of palladium, which is used in catalytic converters. The price went from $1,800 an ounce to over $3,000 in a matter of months. Why? Because auto manufacturers absolutely needed it to meet production schedules. They couldn't just stop making cars. They paid whatever it took. Silver is used in even more critical applications, and the supply situation is far more precarious than palladium ever was. Now, let's talk about what happens when the paper market breaks, because that's the real event horizon here. The Comex has operated for decades on the assumption that only a tiny fraction of contract holders will ever demand physical delivery. It's a fractional reserve system, just like banking. And just like banking, it works fine until everyone wants their metal at once. We almost saw this happen in March 2020. During the COVID panic, the spread between Comex silver and London silver blew out to over $1. Arbitrage traders couldn't get metal from London to New York fast enough because flights were grounded. The Comex came within days of a delivery default. They solved it by allowing London bars to be used for delivery, but that was a band-aid, not a fix. Today, the situation is far more precarious because the inventory cushion is gone. In 2020, there were still 150 million ounces in registered vaults. Today, we're at 41 million and falling. It would only take a handful of large players demanding delivery to completely drain the system. And once that happens, once the Comex can't deliver against contracts, the paper price becomes meaningless. Physical silver will trade at whatever price clears the market, and that price could be multiples of the paper price. Think I'm exaggerating? Look at what happened with nickel on the London Metal Exchange in March 2022. A short squeeze forced prices from $25,000 per ton to over $100,000 per ton in 2 days. The LME had to halt trading and cancel trades because the system couldn't handle it. That was nickel. a market with far more liquidity and far less investment demand than silver. If silver breaks, it will make the nickel squeeze look tame. Here's what's keeping me up at night. The setup is so obvious that I'm seeing mainstream financial media starting to notice. When Bloomberg and the Wall Street Journal start running articles about silver supply concerns, that's usually a sign we're in the late innings. The smart money has already positioned. The question is whether there's still time for everyone else. And this is where the closing window becomes critical. Because once this goes mainstream, once retail investors start piling in, the physical market will lock up completely. We saw this in 2020 when gold and silver briefly spiked. Dealers sold out of inventory within days. Premiums went to $8, $10, $12 over spot. And that was with much higher inventory levels than we have today. I'm hearing from multiple sources that some of the largest bullion dealers are already implementing allocation systems for their wholesale customers. That means even if you're a dealer trying to buy 5,000-ounce bars, you're being told you can only have a certain amount per month. When wholesale is being rationed, retail is about to get very difficult. Let me give you another data point that's not getting enough attention. The U.S. Mint's silver sales are running at the highest pace since 2015. In January alone, they sold over 5 million ounces of silver eagles. That's just one product from one mint. When you add up global investment demand across all products and all countries, we're looking at numbers that simply can't be sustained with current supply. And here's the kicker. Most of that investment demand is coming from small retail buyers. The big institutional money hasn't even arrived yet. When pension funds, sovereign wealth funds, and family offices start allocating even 1 or 2% of their portfolios to physical silver, we're talking about hundreds of billions of dollars of buying pressure hitting a market that does maybe $30 billion of annual investment supply. The math is terrifying. Now, I want to address something I hear all the time. But silver's been a terrible investment for years. Why is this time different? Fair question. Silver peaked at $49 in 2011 and spent the next decade going nowhere. A lot of people got burned buying at the top and holding through the decline. So why should anyone believe this time is different? Here's why. The 2011 spike was purely investment-driven. It was momentum, speculation, fear of inflation that never really materialized. Industrial demand was growing, but it wasn't the driver. Today, industrial demand is the foundation, and it's not speculative, it's structural. The world is electrifying, and electrification requires silver. That demand isn't going away regardless of what investors do. Second, the supply situation in 2011 was completely different. We had ample mine production, healthy inventories, and no real supply constraints. Today, we have declining production, depleted inventories, and supply chains that are already stretched thin. The fundamental backdrop is night and day different. Third, the monetary environment is different. In 2011, central banks could still pretend they had inflation under control. They could still raise rates without breaking the financial system. Today, that's no longer true. We're in a world of permanent monetary expansion, and everyone knows it. That's why gold is at all-time highs. Silver is just catching up. But here's what really makes this time different. The paper market is breaking. In 2011, the Comex could handle the surge in demand. They had inventory, they had credibility, and the system held together. Today, the cracks are visible. The inventory is gone, the premiums are exploding, and trust in paper claims is evaporating. When the paper market breaks, we're not talking about silver going to $50 or $60. We're talking about a complete repricing of the metal. Let me walk you through what I think happens next, because this is where it gets really interesting. We're currently in what I call the quiet accumulation phase. Smart money is buying physical metal as fast as they can source it, but they're doing it quietly. No headlines, no fanfare. This phase ends when either inventory gets so low that dealers start refusing to sell, or when a major player demands Comex delivery and exposes the shortage. Once we move into the recognition phase, that's when mainstream media picks up the story. That's when your neighbor starts asking about silver. That's when premiums go from $4 to $10 overnight. This phase is characterized by panic buying and complete inventory depletion. If you're not already positioned when this phase starts, you're probably too late for physical metal. The final phase is what I call price discovery, and this is where things get wild. This is when the paper price becomes completely disconnected from physical reality. This is when you see silver quoted at $35 on the Comex, but physical bars trading at $60 or $70 in private transactions. This phase ends only when either new supply comes online, which takes years, or when price rises high enough to destroy industrial demand, which would require prices well into triple digits. Now, I'm not saying silver is going to $100 next month. I'm saying the setup exists for a move that could take silver to levels that seem absurd today. And more importantly, I'm saying the window to position yourself in physical metal at reasonable prices is closing rapidly. Here's what you need to understand about timing. In markets like this, the move happens faster than anyone expects. Silver can sit at $28, $29 for months, lulling everyone to sleep. Then suddenly, in a matter of weeks, it's at $45 and there's no physical metal available at any price. The move from everything's fine to complete shortage happens in the blink of an eye. I saw this firsthand in March 2020. On March 15th, you could buy silver at $15 an ounce with normal premiums. By March 25th, dealers were sold out, and premiums were $8 over spot, if you could find metal at all. The entire market locked up in 10 days, and that was with much higher inventory levels than we have today. So when I say the window is closing, I'm not being hyperbolic. I'm watching the same indicators that preceded every major silver shortage in history, and they're all flashing red simultaneously. Low inventory, rising premiums, increasing industrial demand, declining production, and growing investment interest. That combination has never failed to produce a significant price move. The question you have to ask yourself is this: what's the cost of being wrong? If I'm wrong and silver just sits here at $30 for the next year, what have you lost by owning physical metal? Maybe you've got some capital tied up earning no yield. Maybe you paid a small premium. But if I'm right, and we're heading into a genuine supply crisis, what's the cost of not being positioned? Because here's the thing about physical silver. Once you own it, you're insulated from the chaos. You're not worried about Comex delivery failures. You're not worried about paper claims being worth less than the paper they're printed on. You're holding real metal that has 5,000 years of history as money and is simultaneously critical to modern technology. That's a pretty good place to be when markets are breaking. I'll leave you with this thought. Every major wealth transfer in history has happened when most people were looking the other way. The people who bought gold at $35 in 1971 before Nixon closed the gold window. The people who bought real estate in 2010 when everyone was terrified of another crash. The people who bought Bitcoin at $1,000 when everyone said it was a scam. They all had one thing in common. They saw the setup before it was obvious, and they acted while everyone else was paralyzed by uncertainty. Silver right now is offering that same opportunity. The setup is there. The fundamentals are there. The technical indicators are there. The only question is whether you're going to act while the window is still open, or whether you're going to wait until it's obvious to everyone, at which point it will be too late. The closing window I'm talking about isn't theoretical. It's measured in the declining inventory numbers we see every week. It's measured in the rising premiums we see every day. It's measured in the increasing difficulty of sourcing large quantities of physical metal. And once that window closes, once the market locks up, there's no going back. You either positioned yourself beforehand, or you're left watching from the sidelines as one of the greatest wealth transfers in modern history unfolds without you. The choice is yours. But make it fast, because this window won't stay open much longer.